All right, that's 2.5 minutes. Does anyone besides Sergio want to show us how to calculate the tax rate or the taxes, the employment taxes on this amount of income?
I can.
Okay. Thanks, Olivia.
No problem.
What would I do here?
So since his wages were below like both of the thresholds to be the higher amount, I just added the 6.2% and the 1.45%, and I multiplied that by the 75,000.
Nice. Super easy, straightforward, right?
Yeah.
So just because, oh, dang it. Just because everyone loves to know, what was the answer you got?
So
The answer I got was $5,737.50.
There we go. So that was really easy because we were below the FICA cap. So in a way, we can just apply the 6.2 and the 1.45 for each, the employee and the employer. They're both going to pay the same amount. The employee is going to pay $5737.50. The employer is going to pay $5737.50. Pretty straightforward. Thank you, Olivia. I appreciate that. Any questions about that calculation? Okay. So again, we'll deal with something a little more complicated later, so there's no reason for us to spend any time at this point going through those. So you can see that we've actually dealt with a number of these different taxes, but these are kind of the definitions of tax rate structure. So the federal income tax, that's a progressive tax, right? The rate went up as the base increased. Social Security, that's actually a regressive tax, right? Because as the rate went up, or as the wages went up, as the base went up, the rate actually went down. It went down to 0. So technically, Social Security taxes are regressive. It used to be that the Medicare portion was proportional. Everyone paid the same 1.45 no matter what, but then they introduced that additional 0.9. So we can't even argue that Medicare is now proportional, but you could say for the employer it is. So every employer is going to pay the same amount regardless of the level of wages in terms of the rate is the same. Okay, so now let's do one more example. We got Patrick, who's also a single taxpayer. Taxable income is 65, 10,000 on interest for tax exempt municipal bonds. So what I want you guys to do is calculate these first two items. So first, what is Patrick's income tax, which really straightforward, I think. And then let's calculate his average rate of tax. Let's do those two things right away. So again, I'll set the timer for about 2 minutes this time because I know you guys are getting faster. All right. So you should have done something that looks like this. Everyone okay with that? Any problems? And then if I want to measure the average tax rate, what do I use as my denominator?
Taxable income.
Taxable income. Heard someone say it. Taxable income is right, which in this case is 65,000. So I get a rate of 15.46%. So again, that's that blended rate. It's a weighted average rate of a little bit of 10%, a little bit of 12%, and a little bit of 22%. And notice that the exempt income is not part of the average tax rate. Now let's talk about this increase if Patrick makes an additional dollar. Well, it's really straightforward to think about what that would be. There it is. So instead of making 50 cents, 10048.50, it's 72. He pays an additional 22 cents of tax on that dollar because he's in the 22% tax bracket. So we call that the marginal tax rate. And we use the marginal tax rate for planning. And this is particularly important for individuals because they have such progressive tax rate structures in both the federal and the state, especially the state of California, the income tax rate structures. So we always want to be a little bit cautious. That's not the technical definition, however, of the marginal tax rate. That's actually the change in tax over the change in income. But if we think about that, the change in tax was 22 cents. The change in income was $1. That's the same 22% marginal tax rate. And again, we use that for planning. So the effective tax rate is very similar to the average tax rate, but we use a different denominator. Does anyone know what the denominator is for the effective tax rate?
75,000?
Yeah, Anna says 75,000, and that represents, in this case, total income, right? And I think the book describes it as total economic income. So I like to think of it as, well, economic income, that might include some things that we haven't realized. So I tend to back off that definition a little bit, but I do like the definition total income. So the effective tax rate, and you can do that math, right? That's just a simple use of a calculator. All right, let me clear my drawings and let's go on to the next slide. Okay, so just to be clear, corporate tax rates, I just realized I haven't been on big screen. Corporate tax rates are a flat 21%. So that means that no matter what your income is, you pay at 21%. So that's been true since 2018. And it doesn't really matter how big the corporation is or how small the corporation is. So that means that your marginal, your average, all your rates, your effective rate, they're always at 21%. Now, a corporation can generate some tax exempt income. So maybe the effective isn't at 21%. Here are the technical definitions of those, which I think are really the same as what's in the book for the most part. All right, so before we move on, can anyone unmute and tell me about some other taxes? What other taxes are out there that you've heard of? You can raise your hand, you can unmute, you can put it in.
Sales taxes?
What kind, Donna?
Sales taxes?
Sales taxes, absolutely.
Estate tax,
Let's go with John.
estate taxes.
Estate, yeah, and estate is bundled with gift, isn't it? Gift and estate taxes belong together. And what we'll see in a second is those are actually called the unified transfer taxes. It means in the book that way too, but that's because they are unified. So estate and gift, sales tax, any other kinds of taxes?
Property taxes?
Yeah, property taxes, right? We'll talk about those before we're done this afternoon. Wow, I guess I slept in late. Anything else?
Excise taxes?
Excise taxes. That's right, my Ellie. So excise taxes are on, typically we think about things like tobacco and alcohol. A lot of times sin taxes come in the form of an excise tax. A sin tax is really, that's just a classification of a way of describing a tax as trying to modify taxpayer behavior. So we tax cigarettes and alcohol in theory to tamp down the use of cigarettes and alcohol, sin taxes. Heavy excise taxes on recreational marijuana in California. I don't know whether that's a sin tax or it's just like, hey, that's easy revenue, so we're going to charge a lot. That covers, I think, most of the bigs, right? So let's go back. Oh, I got to continuously remember to share my screen. Let's go back to the slides again. Here we go. So here's what the California income tax rates look like. And you can see that we have similar brackets, right? Well, this is, again, single taxpayer, but we have brackets. Now you can see the rates are pretty different. We go from 1 to 12.3%. And it operates, largely the same way. It's whatever bracket you're in. You subtract out the beginning of the bracket and then add some amount that represents the tax for all the previous brackets. California also has an additional 1% that they don't put in their tax table usually. That's because it's on incomes over $1 million. So there's an additional 1, and it can actually push the individual income tax rate up to 13.3. You see that California has progressive tax rates. They're also pretty high. The reason we know they're pretty high is you can look at the Tax Foundation's Business Tax Climate Index. So what they do is go out and measure a number of the taxes that a business might be subjected to. And you can see that California is 49th. That means we are the second highest taxing state in the nation. New Jersey is higher than us. So it's, California exceptionalism, I guess. Here's why. If you look at the breakdown, the overall rank, again, 49th, corporate tax 28th, that's kind of middle of the pack. That's not so bad. But the individual income tax, we're ranked 49th. Sales tax 45th. California has high sales taxes. Property taxes aren't too bad here because of something called Prop 13 that we'll discuss. And our unemployment taxes really aren't all that bad. We're, again, middle of the pack. So really our tax climate is being driven by the individual income tax, and that is largely a part of its high rates and severe progressivity. So to witness what that progressivity looks like, if you had a single person with about $2 million of taxable income, their federal income tax would be about $704,000. That's about 35% of their income. The employment tax is about $54,000. That's 2.7%. That doesn't include the employer share. For those that have taken me for undergrad, you know that actually the employee pays both shares economically, but neither here nor there. The state income tax is about $240,000. That's about 12% for someone who makes $2 million. So if you look at that, the total average tax rate on income taxes plus employment taxes is 49.7%. So kind of out of the box, they're paying about 50% on the average. And this is why you do hear the affluent complain about pushing tax rates down lower and lower and lower again. I'm not suggesting that's necessarily the right answer, but that is one of the reasons they argue for that, is because about half of what they make is being paid out in just these 3 taxes. So we mentioned transfer taxes, gift and estate taxes. This is really a tax on the transfer of wealth, right? It's not a tax on how much you own. It's how much you own that you're giving to someone else. And the gift tax is when you give it away when you're alive. The estate tax or death tax is when you give it away when you've died. And this tax is on the giver. It's not on the recipient. Gifts are actually tax-free to the recipient, income tax-free at least, and transfer tax-free as well. The 3 primary exclusions, the 3 things where you don't have to pay a transfer tax, is there's an unlimited marital exclusion. So if one spouse dies, if as a function of their will or state law, if they just give everything to their spouse, there's no estate tax, there's no transfer tax on that. There's also an annual exclusion up to $15,000 per donee. So that means that I could give my kids $15,000. I could give my friends $15,000. I could give a stranger on the street $15,000, and I wouldn't have to pay any gift tax on that amount. Because I'm married, if my wife and I both did it, we could give each of those people $30,000. And then the other big exclusion is what's called the unified credit. And we'll see how that unified credit applies to both estate and gift taxes, but it basically translates into a deduction of 11.7 million. So what that means is your total transfers would need to exceed, let me rephrase that, your total taxable transfers would need to exceed 11.7 million before you pay any taxes. So as a result, this really is only a tax on the affluent. The vast majority of us never accumulate wealth anywhere near that amount, and generally would never be subject to gift or estate taxes in any way. So here's what the gift tax formula looks like. Because it accrues over the lifetime of any individual, you add up all the gifts that were made in the current year, you subtract anything that you're allowed to subtract like that exclusion we talked about. You can also deduct charitable contributions. Then you add all taxable gifts in prior years. That gives you your cumulative amount of transfers. You apply a rate to that. That gives you the rate. And then you'd apply what this unified credit is. You'd also get the credit for any taxes you paid in previous years, of course. The estate tax, which is, again, the transfer tax that applies at death, works in a very similar fashion. So you start with what's your gross estate, because, of course, you've died, which means you got to give it all away. So you measure that gross estate. You're allowed a deduction for your cost of funeral, the administration expenses, any debts that you owe, of course, right? That lowers the value of your estate. You get to deduct those. And again, charitable contributions, this is pretty common. A lot of people will give their money away when they die, you know, like, oh, I need it till then, but once I die, I know if I have some, I'll give it away. So you get a deduction for that. And that's good incentive for charitable contributions. And then, of course, the marital deduction as well. You take that and then you add all the taxable gifts that you've made. So notice that what we're really doing is adding up your total amount of transfers. To that, you would apply the tax rate, and then you deduct the credit from that. And again, that credit is equivalent to about $11.7 million of gross estate, so or taxable estate. Then you would deduct any gift taxes you paid previously, and that would tell you, okay, how much tax do I owe? As worth repeating, obviously only applies to the even affluent people. And even given the price of homes in San Diego, most of us still aren't going to owe any estate taxes. So again, the state is typically measured as the property at the fair market value at the time of death. You can elect an alternative date if it results in a lower tax. And notice again how taxable gifts become part of that unified transfer tax. Again, I'll point it out to you, assuming you can see my cursor on the screen. We added those taxable gifts in before we applied that credit. Here's the tax rate structure for estates and gifts for that matter. And you can see that they're pretty progressive. End up at 40% over $1 million. But because the unified credit exists, it largely means that it's really applied at about 40%. So a 40% rate is a pretty high rate. To give up, again, 40% of your accumulated wealth at death can be a pretty big bite. This isn't an estate and gift planning course. There is one of those in the finance department. And there are, of course, techniques to try to get around these taxes. So let's do a quick example. We've got Bill. He's a senior single taxpayer. He dies in 2021. He's made no previous taxable gifts. He's going to donate $500,000 of his investments. His funeral is expected to cost $50,000. Everything else he's just going to leave to his one cousin, Steve. So the first thing we would do is value Bill's estate at the time of death. So I've provided that information. He's got some bank accounts. He's got some investments. He owns a home. He owns a vacation home as well. And then he's got a bunch of personal property like his cars, his furniture, this sort of thing. His total estate accumulates to just about 8.5 million, right? 8.49 million. He's made a charitable contribution out of his estate, so he gets to reduce the value by the 500,000. He gets to reduce it for his funeral expenses. His net taxable estate is about 8 million, just shy of 8 million. Multiplied by 40%, his tax would be about 3.2 million. But again, he gets to apply that credit. In 2021, the credit is about 4.6 million. That wipes out all the tax. So you can see that you really do need to have a fairly sizable estate before you're going to pay any of these transfer taxes. So before we move on to the next topic, does anyone have any questions? Stop there for a second. All right, hearing none. Let's keep rolling then. So here's the estate and trust income tax table. Now notice this is very different. This is not a tax on the value. This is actually a tax on the income that an estate or a trust can generate. So, let's say I die in 2021 and I have a bunch of investments, and it takes me a year and a half to unwind my estate because, oh, my heirs are fighting over who gets what. And in the meantime, I have a bunch of investments that are paying dividends. So unless I'm distributing those dividends, I have to pay tax at the estate or trust level. And you can see on that income, and you can see that the rates are super progressive, right? At $13,000, I'm already at 37%. And these rates are clearly designed to prevent us from shifting income into a trust and trying to avoid paying income tax on it ourselves. And that is exactly what they do, because you see the trust rates just skyrocket really fast. So California has property taxes. Most states do have property taxes. Most of them apply the property tax to real estate. So that's your home, it's land, etc. Less common in some states is a property tax on personal property. So again, that would be like your furnishings, other things you own. There is a tax on personal property in California. It is on your vehicle. It is on your auto. So we do pay property taxes on our autos here. Generally, property taxes are based on the value of the underlying property. That's called an ad valorem tax. That is not true for real estate in California, because we have this thing called Prop 13. Prop 13 says, no, it's based on the original cost, and then you can increase its value by only a little bit every year. So basically, it doesn't necessarily follow the general rate of increase of property over time. And so what happens is unlike most states, our property tax is based on some artificial value as opposed to some sort of market value of the underlying property. So this is what home prices have done since 1987 in San Diego. This is the Case-Shiller San Diego Home Price Index. So this is an index that tracks only the resales of actual homes. So it's really reliable from a measurement perspective, but you can see it's not really too quick. So the last date available that I could find was October. Probably if you pay, you can get it a little more up to date than that. But because you're paying for such a reliable index, it takes a little longer to get to you. And you can see that this is an index, so it's not measuring the value of the homes. In fact, I think the Union Tribune published those on Saturday or Sunday this past weekend. But the index value back in 87, the start of 87, looks like it was about maybe 50 or 55. Now it looks like we're at about 360. So you can see housing prices have gone up. And if you measure that, the average return, if I bought a home on that first day and held it and it matched the index, that's a 5.72% return over those 34 years. So that's a pretty good return. But just to put that into contrast, if we look at the Wilshire 500, which is a measure of the 500 largest stocks in the United States, over the same period, 87 to the end of October, the average return is almost 11%. So you can see that really stocks have done better than housing, in spite of the fact that we always scream about how expensive housing is. And it is expensive, don't get me wrong. But if we had put our money into stocks, we actually would have had a better return. Now, I don't want us to all necessarily go out and buy stocks as a result of this. One of the issues that we didn't consider when we did this quick calculation is how much easier it is to borrow money to buy a home versus borrow money to buy stocks. So once we leverage the purchase of that home using someone else's money, usually a bank's, our returns actually rocket way up. And that's what makes housing such a great investment. Here's what a California property tax bill looks like. You can see that they valued land and improvements. Again, that's not the current value. That's just the value based on Prop 13. That gives you the net taxable value at the bottom. There is an exemption if you live in your home. You can see that's a whopping $7,000. And even in the most modest San Diego homes, $7,000 means almost nothing. So that homeowner's exemption is worth basically nothing these days. And then on top of that, you'll see that in most municipalities inside of San Diego County, there are a number of other taxes that get added on to what you would describe as kind of the state property tax. So that's up at the top. There's the 1%, right? But then you look, this is a property tax bill from Poway. And by the way, property tax bills are public. You can look up someone's address and look at their property tax bill anytime you want to. But you can see there are a number of voter approved taxes, like there's one for Palomar Health Debt Service. So that was, new hospital up in North County. Here's one for the community college up there. Here's one for Poway Unified. Floated some bonds to pay for schools. And then there are some other assessments that this is in the city of Poway that they also run through your property taxes. So you've got some roadway improvements, mosquito control, that's the vector, looks like some fire protection, some landscaping, things like that. So all these total to the bill that you would actually see. And if you're interested in more about Prop 13, I posted some optional reading that has a really great description. It's a research paper by someone up at Stanford Law, that looks at Prop 13 and how it skews how taxes are paid and how that really affects both the property tax and the market in weird ways. So California has sales taxes. Sales taxes are a state base rate of 6%. Then every county chucks in 1.25% minimum. And then municipalities can add more. And I'm not sure what Santa Diego is, but I assume that's just a typo and it should be San Diego is 7 3/4. El Cajon, you can see, is 8 1/4. National City, 8 3/4. Del Mar, 8 3/4. And these change all the time. Well, not all the time, but they change frequently enough that you really would want to go out and check what the current rate is for any particular municipality. Here's what the breakdown of that 7 1/4 looks like, because as you can see, it's not really a single flat rate. The flat rate is technically the 3.6875%. And then there's a number of other different kind of add-ons that have come over time. Some of these have been passed by assembly. Some of them have been through voter reform. And so, but in any event, you can see they add up to the 7.25%. And yeah, no, there's no way you need to memorize any of this stuff. So here's the highest, I don't know, whatever fit on the page, sales tax rates in the state of California. And note that all of them are in Los Angeles County. So if you want to buy, clothes or whatever, don't go up to LA to buy them unless that's the only place you can buy them, because you can save about 3%, which I know isn't a ton, if you just bought them in San Diego. Here's the lowest sales tax rates in California. And again, you can see that 7.25, that's the bare minimum. So what that means is these municipalities are not charging any additional sales tax on top of the state and county. And if you look, most of these are pretty rural locations, these counties and cities. So as a result, it's probably that they're not providing a lot of services to those taxpayers either, because they're rural, and so there's not a lot to provide. So this is not necessarily considered to be gospel, but some people will claim that sales taxes are regressive, and they are if you compare them to income. Now, on purchases, if the base of sales taxes is purchases, which of course it is, they're actually flat, right? Now, again, they can vary from place to place, but if we each buy $100 item and we're each in a location that charges the 7 1/4%, we're going to pay $7.25. But if we compare that to income, and the reason people like to compare sales tax to income is because if you view it more as a consumption-based tax, and you say, well, look, if I look at if purchases of necessities are the same across no matter what level of income you are. So purchases of food, clothing, and again, shelter tends to be not subject to sales tax, but food and clothing, we both pay the same regardless of our level of income, under the assumption that we would buy about the same amount of food or clothing, right? Obviously, rich people tend to buy more expensive clothes, more expensive food, maybe eat out more often, that sort of thing. Whereas lower income people probably buy less expensive of those items. But all the same, if we assume a flat surface for necessities, then you can see that the rate goes way up if you're lower income, because you have more income to spread that consumption across if your income is higher. So sometimes you'll hear sales taxes described as regressive, and this is kind of the the environment under which that's being described. This is another reason why a lot of states, including California, will tax exempt certain items. So if you go to the grocery store and buy food, for the most part, that's something we cover in a different graduate course, but for the most part, most of that is not subject to sales tax. Medicines tend to be not subject to sales tax for all the same reasons. Excise taxes were mentioned. These tend to be taxes on gas, tobacco, and alcohol. They tend to be volume-based, and most of the time, you won't even know. You'll have no idea that it was an excise tax versus a sales tax. They'll just charge you it, and you'll pay it. There's also a value-added tax, but we don't have that in the United States. Very common, however, overseas. Very common to have VAT tax in other countries. So our gasoline tax, the federal rate is 84 or 18.4 cents a gallon. Of course, the rate can vary across states. And congratulations, if you're currently residing here because you're virtual. If you are residing in the state that has the highest gasoline tax of anywhere in the nation. We're number one. That's California exceptionalism for sure. When we want to break down California's gasoline tax, it starts with an excise tax of 50.5 cents a gallon. And then there's actually a sales tax on top of that of 2.25% based on the amount you pay at the pump. And then there's another county level sales tax that's actually based on a weighted average for all the gas pumped in the county. So what they do is they collect all the information about where gas is pumped in different places, because you saw that sales tax can vary based on location. So as a result, they do a weighted average, then that gets baked into kind of next month's gas tax. And then there's a 2 cent per gallon underground storage tank fee as well. We also have unemployment taxes. No one really mentioned these, but this is another tax, but it's a tax that's collected to provide a social safety net for people when they're unemployed. This is a combined federal and state program. So technically what happens is the federal government charges 6% of the first $7,000 of wages for unemployment taxes. However, the federal government also permits a credit to what you pay to the state of up to 5.4%. So what that means is you take that 7,000 of wages, a big portion of it is going to the state and a very small portion of it is going to the federal government, but they work in tandem with these unemployment trust funds to help, pay for unemployment when claims are filed. And as you can imagine, there was a lot of that during the COVID period. Okay. So the last part of chapter 1 I want to talk about is what the author describes as a good tax, and let's put that in air quotes, because I don't know if any tax is a good tax. Maybe the tax that someone else pays is a good tax. In any event, these are typical characteristics of a tax that we almost all agree as individuals are good characteristics. So the first is equity. We want taxes to be fair. And fair is definitely in the eye of the beholder. As I just mentioned a second ago, like, is it fair that I pay any taxes? Well, no, maybe you should pay all the taxes. That's called horizontal equity. So horizontal equity means that two people that make the same income would pay the exact same tax. So that's kind of like, well, if you make the same and I make the same, why wouldn't we pay the same tax? Yeah, that seems fair. Vertical equity says that taxes should be based upon the ability to pay. And that's why we have progressive tax rate structures. So in spite of the fact that we all think like, oh, a flat tax would be awesome, research has shown that really the bulk of the US, the bulk of the citizens, voters in the US actually agree that kind of the more you make, the more you should pay. And so that's why we have progressivity that represents vertical equity. Certainty means that taxes are predictable and there's enough of them for the government to operate. Income taxes have become less predictable than before. I think we talked a little bit about estate and gift taxes changing from year to year. Now we're in a system where income taxes are changing from year to year, and not just the cost of living adjustments. Those are all very predictable. What's less predictable is when we write tax code and we give it expiration dates. So we're coming up on this big expiration of a lot of the Trump tax cut items at the end of 25. No one knows what's going to happen to those in 26. So that will create unpredictability that will increase the closer and closer we get to that cutoff period. Now we've even got, because there was some tax reform in 2021, we even have changes that expire within the period 2018 to 2025. So all this kind of lack of certainty makes it more difficult for us to make good decisions. Convenience means it's easily administered, and that's not really convenience from, oh, how easy it is to fill out a tax return. That's simplicity. Convenience is, the reality is most income taxes in the US are pretty convenient. Sales taxes are really convenient. So let's start with sales taxes. Like if you don't pay the sales taxes, you don't get to leave the store with the item. And so as a result, like that's considered to be convenient because it's just automatically taken, you pay for it and off it goes. The bulk of income taxes are convenient because the vast majority are paid through withholding by employers. And so as a result, we really think of the income tax system as being pretty convenient. It's not perfect, but pretty convenient. Economy means low cost. That's how much money does the government spend to collect every dollar. Amazingly, that's not very much. The cost is really pennies per dollar for income tax in the US. And simplicity, well, we fail, right? Our tax code is horrifically complex and extremely difficult for most people to understand. So don't do too well on that front. So when we think about entities in the federal tax system, taxpayers are individuals and corporations. They both pay income taxes, whereas flow-through entities, sole proprietors, partnerships, S corps, LLCs, and trusts, although trusts can pay, depends on how the trust is organized, their flow-throughs, they technically don't pay, at least federal income taxes. All the income just flows through to either an individual or a corporation, where they pay tax on the income. So let's say Bob has a portfolio of investments that pay interest and dividends, and Bob is also a wage earner. Bob also runs a small business out of his garage. So all of these are going to end up on Bob's Form 1040. First, the interest and dividends are going to come through a Schedule B and eventually get, I want to say line 2B on his 1040. His wages, they're reported directly on the 1040 as line 1. The small business profits, first Bob will prepare a Schedule C. That Schedule C, the income then ultimately goes to Schedule 1, then ultimately goes to 1040. But in none of these cases is there some separate tax, right? Bob reports all these items. There's no separation between the activity and Bob. Jane is a wage earner, but Jane also owns an interest in a partnership. That partnership operates a small business completely on its own. And it has some investments. They also pay interest and dividends. So just like Bob, Jane's got to report all of these items. But the partnership, even though it's a separate legal entity, isn't a separate taxable entity. Now, that's not to say that the partnership doesn't prepare tax returns. It does. But the purpose of those tax returns is, number one, to inform the IRS, and number two, to inform the partners of the partnership as to how much income they need to pick up on their individual tax returns. And the cool thing about flow-throughs is whatever the character of that income is, in the partnership, it's going to stay the same as it goes down into the owner. So if Jane's partnership earns dividends, then Jane reports that as dividends. That's not true in the corporate form. But again, we're not going to spend a lot of time on corporations because this is about individual income taxes. All right. So in a flow through, the income is allocated to those owners every year or every tax period. Cash may or may not be distributed to those owners. Those are not the same. So if Victoria is allocated $20,000 of income from her membership in a Moldova LLC, and an LLC is a flow through, and she also receives a cash distribution of $10,000, how much taxable income does Victoria recognize? She only is required, generally, she's only required to recognize the $20,000 of income allocated. In a flow through, typically cash distributions are non-taxable to the owners. Typically non-taxable. Okay, so again, we talked a little bit about Jill tax-paying entities. Jill's a wage earner. She invests in a corporation. That corporation is a tax-paying entity, so it pays its own tax. But that's not to say that corporate income doesn't ultimately flow through to owners. It generally does, and the form under which it does so is often through a dividend. The corporation pays a dividend to its owners. When that comes through, you can see that both the corporation will pay tax on its income, and now the owner is going to pay tax on the amount of dividend it receives. So really, the joint means that there's a form of double taxation. Double implies that it's twice the amount. That's not true, but the income is taxed twice. So again, trusts sometimes are a flow through, sometimes aren't. It really depends on whether the income is going to be distributed to the beneficiaries, how the trust was defined. That's kind of beyond the scope of this course.